30 to 40 year amortization.
Yeah.
How do we do that?
So 30 to 40 year amortization, just to be clear, up to 30 years we can get with conventional banks. Outside of 30 years is alternative lenders.
Yeah, because for insured mortgage, we can go up to 25
Yes.
years amortization. With
Yeah.
20% more, with uninsured mortgage, we can go up to 30 years.
Exactly.
And when we talk about 35 to 40 years, that is kind of shocking. And so spill your beans, like how exactly we do it.
So the way it works is alternative lenders, there's a few of them in this inner space, in inner industry, that have, I can't say they're the same interest rates as the banks. They might be at a 0.5% or 75 basis point premium. But if that can get the client a lower mortgage or help them qualify for more, then a 35 to 40 year mortgage in some instances does make sense, because at the end of the day, the interest rate environment we're in right now, we have to not just consider having a client buy a house and convince them that they should buy a house because market's going to go up. We also have to find ways to make sure that they can actually afford the home and they can actually budget for that mortgage within their, like, whatever data, financial budget, right? So if, let's say, a 35 or 40 year mortgage makes it more affordable, I usually suggest it to them for at least a couple of years in this environment until interest rates come down. And then when interest rates are back in the norm, hopefully in that 2.5 to 3.5 norm that it's been for the last 20 years, then we can always bring them back to a 30-year amortization.
Okay. Of course, longer the amortization, lower the monthly mortgage payment would be.
Yes.
But again, debt is debt, right?
Debt is debt, yeah. But also, like, the lower payment also helps people qualify for more. So again, that's another tool in our toolkit. So that might help a client, again, qualify for that 50, 75, 100K more, which could make or break their decision to buy, because now they can see the properties they want to see, right?
Right, exactly.